Welcome, ladies and gentlemen, to Commodity TV and a new episode of our online interviews. We want to get an update from Revival Gold, a gold developer you know very well here on Commodity TV. And we have, first of all, Hugh, Agro, the CEO of the company. And also for the first time, we have John Meyer, who is the Vice President, Engineering and Development. Hugh, John, welcome and good morning to Canada. How are you?
Very good, Jochen. Thanks for having us.
Yeah, great to have you. Thank you very much for taking the time. Hugh, we have done several interviews together already, and I think Revival is quite well known here. I must say, congratulations on the work you have done so far, because you have really executed and you have held your promises. What you say or what you said, you have delivered, and we really like that. And now you guys brought up a new mineral resource, but also the pre-feasibility study for the open pit heap leach to restart. Congratulations on that. That's fantastic, Hugh.
Yes, thank you, and credit to the team at Revival Gold, including John Meyer, who I'm super glad is with us today to talk about the pre-feasibility study. It's a big milestone for us. It comes with a big resource upgrade as well, and I can tell you we're very excited about it.
Yeah, I believe that. I'm excited too, because I'm a shareholder in the company. I have to disclose that also. John, coming to you, you are the one, you are the man who is, let's say, behind the pre-feasibility study. Can you give us some of the highlights and what you have really enjoyed, what you found out there?
Sure. Yeah, it's a great project in that we get to take advantage of a lot of existing infrastructure already that's at the site. And when we develop projects, typically we're really starting with a blank piece of paper, and that also makes it challenging to construct and operate. So what we've got here is we've got a project that we've got already good access to the project. We've got power to the site. We've got an existing gold recovery plant, and it really makes things more straightforward when it comes to development, and much lower risk when it comes to capital overruns and things like that. So what we've really then been able to do and focus on at a pre-feasibility level is really more optimization, as opposed to a big picture thinking about the project. We're really focused on the details, and enables us to develop a pre-feasibility study with a higher level of detail and confidence, I think.
Okay, then let's switch first to some details of the pre-feasibility study. What would be, let's say, the mine of life? What is the average annual gold production?
The life of mine is just over 8 years. The annual gold production is just over 65,000 ounces per year.
At what prices have you calculated that? What gold prices?
The gold prices we've calculated, our reserve price we used was $1,700. That's the price we used to develop all of the pits. The economics that we ran on the project, we ran at $1,800. So we give ourselves a bit of margin there when it comes to design of the pits versus the economic study. Some other aspects of the project we're mining at about 12,000 metric tons per day, so it's a modest size operation, very similar to the previous operation, and using very conventional equipment. 90-ton trucks and loader operation, pretty modest strip ratio at 2.4 to 1 life of mine, and I think it's straightforward and a low risk project. We feel pretty good about it.
Absolutely. When you say you can use conventional trucks, let's say conventional equipment, would you buy it by yourself? Would you use a contractor? How does that work? Because, for example, I know Caterpillar quite well as an example, and I know that those guys provide also financing for equipment, which helps a lot for mining companies. What would be your plans?
Right, that's a really good point. Our plan is to finance the mining equipment, but of course, that said, the lease rates and the lease periods that we've assumed for the pre-feasibility study are 4 years. So it ultimately ends up that we own all the equipment at the end of the mine life, but we get to take advantage of a lower initial capex by leasing. So we spread some of those costs into operation.
It's a good it's a good discussion point though. The fact that this project is located in the western U.S. And access is good, and we're close to serviceable points for companies like CAT and Komatsu. It makes that lease option really attractive for us. And the other thing that I think I would just add to John's comments is that capital is very low on this restart project. We're talking about $200, just over $200 per ounce of gold production, which puts us at the very low end of all of our peers as we've looked about at what else is available in the United States, North America generally. And that makes the threshold for getting into production a lot easier. And I can tell you from the discussions that our CFO, Lisa Ross, and I have had with debt finance providers that there's a lot of appetite for something in this snack bracket, if I can put it that way. It's not a burdensome amount of capital that we're talking about, and gets us into production with that first phase project.
Yeah, absolutely. And I saw also the pre-production capital is $109 million, which I think is absolutely manageable. How much is contingency out of that?
The contingency on initial capital is about 12 million. It's over 20 million life of mine.
Okay, yeah, I think that's absolutely reasonable. And what would be the expected all-in sustaining costs?
The all-in sustaining cost is about $12.35.
So that's also fine. So you would have a nice margin at today's price is 1960, so that looks quite good, I would say.
Yeah.
Right? Yeah. He's smiling. I like that. No, well, fantastic.
And Jochen, I can't help myself here. I got to jump in. That 8-year mine life is, of course, a reserve, right? So we've got another 100,000 ounces or so in inferred material, another year and a half of mine life in inferred material. We've got open deposit at Haiti, where we've got oxide, open pit material with very good leach characteristics, 86% recoveries. And so I think, we'll wind through the development process here, but I would very much expect that 8-year mine life becomes 10, 12 years, and that all those financial metrics just continue to move up. And on the basis of that, very low, as you point out, $109 million of capital. So very attractive situation to be in. But we should talk about the second phase of this project, because that's the other aspect of this news release, is the growth and improvement in the resource.
Yeah, absolutely. Before we come to the underground, I also wanted to ask you exactly about exploration and potential, because I see much, much more potential. And as you pointed out, you could easily go for 10 or 12 years. My feeling is, when I go through your presentation, that you easily could do that over 15 years or even longer. And also what speaks for it is that you have already a lot of infrastructure. So you really can move forward very, very fast. I saw also in your resource update, let's come to that shortly, that you have with 0.87 grams gold per ton, you have already 2.4 million ounces in the measured and indicated, which I think is fantastic, and also 0.87 grams gold per ton. I think that's not too bad, right, for that kind of mineralization you have and how deep it is, right?
Yeah, the average mine grade for the PFS is 0.74 grams per ton gold, which is very attractive. It's, we're talking about cutoff grades in the 0.2 range. So lots of margin there with this project. And as John said, this is a $1,700 reserve pit. So it's a bit conservative by design. Your question about the exploration upside, it's a good one to make. In fact, the drilling started again this week, and we're out doing some exploration on these high-grade oxide targets. In fact, we've got a couple of new targets we're going to be into this year, and we're testing some high-grade follow-ups from the drill program at the end of last year. So it's going to be an exciting next few months in terms of drilling, absolutely. And for oxide material, right down the path here for this project. I want to point out something else for your viewers here too, is John and the team have really designed this project to be a responsible mining operation. We're working on the back of a strong history of compliance with environmental standards, exceeding and award-winning work by our predecessor operators and by ourselves. We've got hydropower, which makes this a very carbon-friendly operation, and of course, the team lives in the community, in the local community, and in the state of Idaho, and so we really do care about what we're doing and how we do it, and that's important, I think, for both the community and our shareholders.
Okay, super. Yeah, I mean, fully understood and fully agreed. That is fantastic. Also, what I saw, let's come now to the underground, what you already pointed out. You have a 180% increase in the inferred resources. I mean, that is also fantastic, isn't it?
Oh yeah, and we're talking about 1 year of work here. I mean, there's a lot that's gone into that, but
Yeah.
just think about the potential for us to expand on that further. We're up to about 900,000 ounces, and the grade's gone up a third in that process in those steps. So we're about 4 grams on average in this resource. We've got a resource thickness of between 3 and 25 meters. We've got a strike length between the northern extent of that underground resource and the southern extent of about 2 kilometers, and lots of infill drilling that we can do along the way. So this is a very exciting phase of the project, and John can speak to why it's important for us to be pursuing this and the advantages of having that higher grade.
Yeah, please, John.
Sure. We focused a little more this past year on the resource modeling of the underground. In the previous iteration that we did, we really just modeled the resource the same underground as it would be open pit. But what we've tried to do is think about it a little more carefully and reduce the block size to something that's more analogous to a mining unit underground versus a mining unit with using large open pit equipment. So what that does, of course, is it's a little more selective, and so obviously that's helped us out a little bit with the grade. But we spent a little more time on the modeling, and you can see that in addition to the drilling, the work we've done on the modeling side of things has really helped us better define what that underground resource looks like. And upping the grade is an important factor, because grade, with grade comes margin, and makes that underground so much more attractive. And I think we've got more work to do there. There's little doubt about that. There's lots and lots of empty drill spaces that we'd really like to fill in, because we feel strongly that there's a lot of upside, but you can see we have to balance off that drilling and exploration against our first phase oxide. So we've been we've tried to take a balanced approach to the exploration. This year we're going to focus more on the oxide, but we'd sure love to also put some more holes into that underground sulfide deposit.
One of the things we can do further to optimize that underground is look at the metallurgy and the possibility of shipping concentrate from that higher grade material, and that's something we're looking at over the next couple of months here. Some test work going on. That, of course, would allow us to lower capital on moving to the next phase of operations at Bear Track Arnett. And if you think about it, you look at our grade and you look at the conceptual 2,500 tons per year in the resource and all the first principles analysis behind that, the 94% recovery, we're talking about something that could take us from that 65,000 ounces a year in the heap leach phase, to north of 150,000 ounces. And then you start thinking about the open pit potential beyond that with a 4.6 million ounce resource. And we could see ourselves over 250,000 ounces a year. So this is one of those kind of prizes that I think is of strategic value, located in the western U.S. in a known mining part of the state of Idaho, and with all the support of the state and the local community, that makes it a special project. In fact, it's the second largest new discovery of gold in the United States in the last decade.
Mhm.
So it's hats off to our team, exploration team under Steve Priestmeyer's leadership, finding costs of less than $6 an ounce in the ground.
Mhm. Yeah, I mean, that's absolutely outstanding. So the thing is now, I mean, you have a fantastic pre-feasibility. How fast can you do the feasibility? And when will we see the decision that you really say, okay, now let's rock it, let's go in production. We start with the open pit, and afterwards you will do the underground. I could imagine that you can finance probably the underground with the open pit, right?
So, Jochen, I think the first thing we need to do is we've just come out with all this, all this information and a lot. I mean, a new block model, a new drill hole database, all the technical study work. I think our technical report's going to be some 400 or 450 pages,
Mm,
and then all the analysis behind that. So we want to get out and tell that story. We want to get out, and speak to the strategics, to the private equity funds, to the streamers and the royalty providers, to the institutional equity, and of course our retail audience, which is broad and which we want to get out and speak to and make sure that they understand the story and the value.
mm,
I think over the next 2 or 3 months we'll do that, and then we'll button up the plans for 2024, 2025. The consultants on the PFS have recommended a staged phase of work right from where we are right now through to production from that first phase operation. The way it looks on that timeline is that we would be moving through our permitting preparations and get to feasibility in 2025, 2026. We could be into construction by the time we get to the end of 2026, early 2027, and producing gold by then 27, early 2028. Now, that timeline, of course, is subject to financing and subject to all the details of sorting out the schedule. But I think we've got a strong foundation to take that forward,
mhm.
and we want to get out and tell that message to all the various different audiences out there, and we'll go from there. Because as you point out, that's just one path, and we can put parallel paths in action.
Yeah,
Like
absolutely.
we've got a conceptual decline that we could go and pursue for underground expansion. We've got lots of drilling that we could do, and the recommended program gives us one path. There's lots of other things that we could pursue alongside of that.
Yeah, absolutely, because we are very bullish for gold, and we see, let's say, for next year, more likely $2,500 plus per ounce. And so I could imagine that also financing is more easy available, etc., and that you maybe can speed up some processes. Would that be possible?
I think that's a possibility. And you talk about option value. That's why we as equity gold investors are in these stocks, because when the gold price goes up, it has a tremendous impact on the real option value that you have exposure to. I mean, think about this. We're at 4.6 million ounces now. In a $2,000 gold price environment, we're already through 5 million ounces in the deposit. And
Mhm.
5 million ounces, a small move in the gold price can have a big impact on the overall NAV and the potential around the economics. So that's why we have these big projects. They offer great exposure and leverage to the price of
Mhm.
gold.
Absolutely. And John, as I know from your bio, that you have worked, yeah, with Fruta del Norte, you have been with Barrick, etc. So you have worked Kinross, of course, very big companies, very big projects. So what has you made to gold with Revival Gold? And as far as I understand, with a larger gold price, we have already the 5 million ounce blocker, which is the big thing, right?
Well, that's right. I think we can see the upside in the project. We're trying to take call it a frugal and responsible approach to development by stepwise starting off with the oxide project. You could see that might question why would we go underground first versus open pit. Well, I would say for Revival Gold, the underground, just makes a lot more sense for us. It does. It keeps our capital down. It's a next logical step when you're then taking the step into the bigger open pit operation. Again, each of these projects can finance the next step, and for Revival Gold, that makes a lot of sense to us. And I would just point out that lots of big mines out there. Goldstrike is a great example. Barrick's Goldstrike. It did not start as a 40,000 ton per day sulfide project. It started as a modest size heap leach project, and they grew with time. And I think that we're taking a similar path, and I think that makes sense.
Absolutely. Last question, where do you see, let's say, challenges or risks by now?
John, do you want to respond to that?
Sure. I think that in terms of our challenges, I think ultimately, obviously, financing, we want to be responsible with our money right now. We want to be careful about that and how much money we put into the ground, into drilling at the moment. I think the other challenge is we still have more work to do on the engineering side of things to firm things up. We've got more work to do on the metallurgical side. We've got more work to do on the permitting side. We've got more work to do on the geotechnical side. I think they're all very manageable, but we've got to get through the work. So you mentioned how fast can we do all this? Well, we can go faster. When we're confident in obviously the balance sheet, and we can charge. But I think all of those things are just things we have to get done. Obviously, metal price is a risk for every project, and it's no different for us. So we have to think about those things. But all things being equal, I would characterize our project as much lower risk when compared to a lot of our peers, primarily because of the fact that this project operated not that long ago on the same rocks, the same process plant, same infrastructure. We're, especially for our initial startup, this is a lot more straightforward than many projects.
Fantastic. Straightforward, that's the thing. I would say, guys, keep it moving, rock it. This is a beautiful start, or let's say a beautiful outcome of the work of the last or 2 years. Thanks for the time, for the interview, and please keep us posted.
Thank you, Jochen.
Thank you very much.
Thank you. Yeah, ladies and gentlemen, that was Hugh, Agro, the CEO of Revival Gold, and also John Meyer, the Vice President, Engineering and Development. Yeah, you heard it, a fantastic PFS, pre-feasibility study. So the guys really had a great result on the hard work they have done the last 12 to 18 months here. And the resources are rising, the reserves are rising, the grades are massively higher. And this is exactly what we want to see. This is already over 4 million ounces now, becoming over 5 million ounces when the gold price goes up to $2,000 per ounce or higher. And don't forget, that's in the heart of the US. It's in Idaho. Yeah, it's not somewhere on the planet. It is really in the heart of mining, in the heart of the US. That is fantastic. It's safe jurisdiction, very plannable, and they know exactly what they have to do. And yeah, they have several options, several phases here. Open pit, underground start. We will see what happens then. But one thing is for sure, it's a great company. Check it out. I'm a shareholder. You hopefully too soon. Thank you very much, and bye-bye from Switzerland.